Hello and welcome to Switzer TV Property. I'm Peter Switzer. We go out on Thursday night, so just go to Switzer Financial Group on YouTube and become a subscriber and click that like button. On tonight's program, we kick off with how the coronavirus might affect property, and we have two economic adversaries / enemies in my old friend Dr. Doom, Professor Steve Keen, and Coolabah Capital Investments, the very intellectually aggressive Chris Joye. How badly will house prices be affected by this damn virus? Both these two guys tackled the subject. And then we have an extensive interview with one of Australia's most respected property economists, the Executive Director of BIS Oxford Economics, Rob Mellor, who gives us an insider's view on what's really going on in Australia's housing market. So let's just kick off with my interview with Chris Joye. Let's go to the thorny area of house prices, and correct me if I'm wrong, but a couple of weeks ago you thought in this cycle house prices could go up 20%. Would you change your view now, because you couldn't have expected the coronavirus?
I didn't, but I'm happy to stick to that view. I'm very confident on housing. I mean, the thing about housing is you're going to get more rate cuts, even more stimulus, and then housing stands out like bull's balls, like two big bull's balls, because housing, is an island of excellence in this extreme volatility that we have right now. And I think a lot of folks are going to look at their super portfolios. They're getting smoked. They're going to look at their shareholdings, and they're going to say, I've got brain damage from the volatility of super and equities. I just like the steady consistency of my housing risk right now. So I think the housing market, I think growth rates will decelerate. Do I think this will KO the housing market? Not at all.
And in terms of banks passing on rate cuts, do you think they'll be morally compelled, or even Canberra compelled to pass them on in full?
Yes, I do. Absolutely. Yeah, I think the banks will be under a lot of pressure, and this is going to be as good a time as any to get passed through. Okay.
One last thing. Do you believe that housing construction is going to pick up? Because you said that there might be a technical recession. Are you therefore in the camp that if you throw all this monetary and fiscal policy at the economy in the the final quarter of 2020, and presuming Donald Trump wins the next election, that we roll into a stock market rebound and an economic rebound?
Sorry, what's the question, mate?
Well, the question is, do you see an economic rebound in the final quarter or even half year of 2020?
Yeah, I think there's a decent chance that, particularly in the final quarter and the second half of the year, we get a very, very strong rebound, like a really strong rebound. Whether that's enough to save Trump's bacon, I think this is definitely an existential threat to his re-election prospects. So let's just wait and see.
Okay, mate. Well, as always, thanks for joining us.
No worries. Thanks, Pete.
Well, this is the property show, and a guy who made property price prediction famous or infamous is Steve Keen, my old colleague from University of New South Wales. How are you, mate?
Good, very well.
So far we've avoided the 40% fall in house prices. Many of your supporters thought it was going to happen a couple of years ago. We went, and Sydney
certainly it started.
Yeah, most definitely. Sydney went down about 15%, Melbourne about 13 or 14%. Is the coronavirus going to actually make this 40% possible?
It could, and that's not something I can say I predicted, obviously. No. But yeah, it could do, because again, if it comes down to the response of the governments initially. If you're a Chinese and you saw the virus spreading through China, one thing, get out to a country with a better health system, Australia, Canada, it would amplify foreign buying. But now it looks like China is going to be more successful at preventing the virus than anywhere else on the planet, because they can simply impose absolutely draconian shutdown. And if some people starve to death in apartment blocks that have been had the doors welded on, which we've seen happening, tough luck. Xi would still become a hero if he gets China to get through this better than any other country. In that situation, it reverses it. You're safer in China than you are going anywhere else in the world. So that could undercut the foreign buying here as well.
Yeah, but can you link the level of indebtedness to the economic implications of the coronavirus?
This is the dangerous thing because so many people are carrying so much debt, and that's where some of the charts would be worth taking a look at now.
Yeah.
We're carrying a higher level of private debt than ever in the history of Australia in particular, and the global economy as well. And in that situation, even with low interest rates, the servicing costs are so high because you're trying to pay part of the principal as well. And of course the distribution of debt on the average, what I'm showing is aggregate debt. Of course there are some who've got no debt, others with a large amount of debt. So the fragility for those who owe 7 or 10 times their income, and suddenly their income disappears because of the coronavirus. A lot of small business people will be in that situation because it'll be the restaurant trade. Anything involving human services will collapse potentially.
Yeah.
And in that situation they can't pay their mortgage, bang, they're out the door.
Okay, ever since 2007, when you first made your predictions about how ultimately house prices could fall, you've seen government respond.
Yep.
And a lot of your supporters, governments will do anything to stop house prices falling.
Particularly the Australian government.
Population, interest rate cuts.
Yeah.
What do you think the government's going to do then?
Well, what I think they should be doing is similar to what they did with in the GFC under Rudd, which they gave $1,000 to everybody with the pulse in the country. That's the old go hard, go early, go households from Ken Henry. We need to do the same thing this time because people are going to be going bankrupt for absolutely no fault of their own. And if they do go bankrupt, then we compound the problem because people who should be inside houses are being evicted. It just makes it disastrous. So the government should be making a large cash injection.
So that's the budget surplus. Forget
it. Budget surplus is stupid economics anyway.
Right.
But the budget surplus means a private sector deficit. If the government takes more money out of your account than it puts in, your account goes down. So the governments are the only organisation which can afford to dissave. It's nonsense to say they should run a surplus in the first instance. But this time round, definitely forget the whole idea, pump the money into the economy and stop the collapse in the private sector, taking the whole economy with it.
But as I listen to this, it seems to me that the solution you're putting out there for sound economic employment reasons will also mean that people can still keep making their house payments. So you might not get the 40% fall again because, in a sense, a rescue program will be to make sure house prices don't fall by that magnitude because that would rock confidence. And
that's quite feasible. Yeah, because again, it's the whole thing that drives up house prices is more money. Okay, now most of the money that's driven up house prices has come from the private banking sector. If you had a government rescue on that scale, then that amount of cash into the economy could rescue the prices as well.
But Steve, does that mean that ultimately, and you've got to be a realist, that in the fullness of time, that 40% fall in house prices might not come about until we actually get an old-fashioned type serious recession that becomes a Great Depression by interest rates rising and there's a complete shutdown of economies. Because remember, it's going to be a Great Depression. I've always thought you're only going to be right if we get a Great Depression because the solutions are so hard, unemployment gets so high, that prices fall, and governments really can't rescue.
Well, I mean, what causes a Great Depression is a collapse in credit, and that's why I might actually take a look at a couple of the other charts here we can flick through. So what this chart is showing is the level of private debt in America compared to GDP, which is the red line. And you can see that private debt now is higher than it was at the peak of the Great Depression. So the level of leverage we're carrying is much higher again. Again, government's much bigger than it was back then, which gives you a buffer that makes them more sustainable. The blue line is what's driving the system, and that's the annual change in debt, and that's credit. When you borrow money, you spend it. That's what's part of aggregate demand. You can spot there are 3 points where the level of credit goes well below zero and stays there. And that's when you have a Great Depression because credit is negative at that time. So there's what's called the Panic of 1837.
So where we see in the middle of that blue line, that's around 1930, that's the Great Depression. And then around the GFC,
that's
it
the
went under
GFC.
as well. And in a sense,
way back,
central banks had learnt a bit from the Great Depression.
No, they haven't.
Well, but they did throw money. In the Great Depression, it took them a long time to actually try and rescue it. Whether the rescue is a good rescue, it actually did work, didn't it?
Yeah, to some extent. It worked to the benefit of the wealthy much more than it did the working class. It wasn't a Roosevelt revolution, that's for sure. First, next chart is Australia. Now, we are carrying a higher level of debt than we've ever carried.
But we've never gone below, hang on, what year was that? 1930, and of course there's the old 1895 one, which was...
The 1890s recession.
Yeah, that was actually worse than...
That was worse than the Great Depression.
But we dodged it in 2010.
That's right. We didn't let it go negative, and
Yeah.
that's why Australia didn't have a downturn like America, and why the house prices didn't fall as well.
And that's a strong argument for the government to respond quickly and promptly.
The trouble is what it's done is it's worked by continuing the increase in private debt.
Yeah.
So if you now go to the next chart, you'll see the comparison of Australian versus American household debt. And we diverged from the world very radically into the great GFC. So we managed to sustain the higher house prices by yet higher private debt. So the household sector now in America has debt of about 75% of GDP.
Yeah.
Australia's 120%.
Yeah.
So we're carrying a much larger debt burden here.
Yeah. So that red chart, the red line on the chart, where it's coming off, is that the house price fall effect?
It starts falling.
But that's going to turn around again.
Yeah. Well, not a lot. It started to turn around a bit. It's still falling at the moment. That's the latest artifact. It started for the data came out on Monday on the weekend.
All right. Okay.
Okay.
So is that rise before that the rebound after the election then?
It's not the rise. The red's coming down right now. It's still falling, but it's not falling as fast.
Okay.
And that what actually is what boosts house prices.
Okay, yeah. Because that rise, the significant rise, that was the house price boom.
That was the house
then
price
it's
boom.
basically gone sideways for a while and started to fall. And I guess if the coronavirus wasn't coming and the current setting of policies, that line would have probably started to rise again.
Potentially. I think we're almost at the absolute saturation level for Australian households, that level of debt.
Okay.
We've pushed it right to the boundary.
All right, last question. What do you think is going to happen? House price wise?
Oh, well, if it wasn't for the coronavirus, I thought it would have run out of steam in the next year or so. Because when you look what we had with first of all, the Banking Royal Commission, I mean, you had Rowena Orr ripping the limbs off the banking sector. Yeah. And then along comes the report written by Treasury. It's a damp squib. Within weeks, they're saying, let's get back to irresponsible lending. They didn't call it that, but that's what it really was.
I wouldn't say that.
Restarted the bubble once more. But you can have your bubble so long as you're willing to carry yet more private debt. Yeah. And that's the situation households are in.
And from my point of view, I've always argued that we can get away with all this if we grow really fast. But we can't grow really fast.
No, we've got
particularly with the coronavirus, that's even made it hard.
We've got a ratted economy. We don't have a manufacturing sector worth speaking of. We're relying upon coal, which may well be banned in the next 5 years. So I think we've borrowed ourselves into a corner. And that's what was. My main complaint wasn't I was trying to gamble which way house prices are going. I was saying this is a terrible way to run an economy.
Yeah. It's interesting that maybe coal's a lesser threat than the coronavirus.
Oh, well, coal doesn't kill you quite as quickly as coronavirus.
No, it doesn't. Steve Keen, thanks for joining us.
Welcome.
That's Steve Keen, of course, the author of Debunking Economics. And what's the website they go to?
Well, actually, it's my Patreon website these days. So Patreon's like a continuous crowdfunding thing, it's called. So it's www.patreon.com/Prof Steve Keen.
Oh, how can anyone remember that?
Oh, well, Prof Steve Keen's pretty easy to remember.
Okay, good.
People
That's
can
Steve
find
Keen.
it.
Well, the controversy over house prices and their recovery and whether this housing sector is on the way back has always been something that the industry's been disputing. Now, I'd always like to catch up with Rob Mellor, who's Executive Chairman of BIS Oxford Economics, because not only has he been around the area of property for a long time, he is one of the most insightful property economists I know. Do I call you a property economist? Because you came as an economist, but you specialise in property.
Yeah, well, my specialty has been building forecasting and property for the last, building forecasting I've been doing for about 40 years, but property forecasting for the last 35.
Which makes you a property economist?
I think so.
Yeah, okay.
Certainly the profile's
All right.
high there.
We've gone through an extraordinary period where the boom was unbelievable, and then the fall looked like it was going to be unbelievable. Now, I think you and I have debated, all the people were saying it was going to be a 40% fall. You never believed it, and I hope they were wrong.
Yep.
And it ended up being what in Sydney?
15 in Sydney, which and was probably, up to June, was probably headed to 17 or 18.
Was it created by regulatory interaction?
Yeah, look, it's one of the biggest nominal corrections I've ever seen in the last 40 years, but probably probably in real terms, it was similar to something we saw in the 80s before the 87, 89 boom took off. So that through the early to late 87 period was a significant decline in prices in real terms.
Yeah.
So it was similar to that, but obviously most of the cycles, particularly if you go back to the 70s, 80s and 90s, are always interest rate driven, and probably even into the 2000s.
Yeah.
Obviously we've had a sustained period of low interest rates over the last 15 to 20 years. And this one was driven by, and you call it the old-fashioned credit squeeze tightening.
APRA basically came and said enough's enough.
And so that basically hit investors as the market started to ease back, exiting of foreign investors in the market, and a dramatic drop-off in demand, and ultimately also in construction with off-the-plan sales. So it was a significant correction.
Yeah.
We always saw that it could be 5, 7, 8%, but to end up being 15% in Sydney and at least 10 or 12 in Melbourne was a huge correction.
Yeah.
But now it's been followed by this turnaround.
Did Bill Shorten add to the correction? With negative gearing policies and stuff like that?
I actually think if you turn your minds back to May last year, as we hit the election, I actually think everybody took it as a given that negative gearing was on the way out, because there'd be a Labor government elected. But I think they just accepted that, and I was surprised by the industry's sort of lack of continuing to fight, but I suspect they would have fought the actual detail of what the removal of negative gearing might have looked like, either in terms of, was it going to be limited to a number of properties, was it exactly what the deal was. And so I think maybe people were turning their attention to that post-election. Of course, the election threw up a surprise. Within a matter of weeks, we had an interest rate reduction and an easing up by APRA, and the rest is history.
Off to the races.
I've never seen anything like this. To think you could be down 15% and you've already recovered inside 8 months, maybe depending on what numbers you use, at least 10 or 12% in Sydney and 9 or 10 in Melbourne, is phenomenal in an environment where until December, you'd have to say volumes weren't fantastic. All the talk about improved clearance rates were on very low volumes, and clearly the private treaty sales weren't fantastic. So, the best indicator of demand for me, and probably turnover, is what's happening in terms of owner-occupied loans and then the investor loans. And you'd have to say, looking at that data, it's only really December that you start to see a significant improvement in turnover of established property, and probably signs that the bottom of the downturn in investor demand has been reached without necessarily seeing a turnaround. Clearly, it's strong turnaround in first home buyers. So the story's pretty good across the eastern seaboard for first home buyers. So that's a positive, but I'd have to say, if there would be a summary point out of our discussion today, my biggest concern is affordability, and that this upturn can't be sustained at the current pace. So if you annualise it, it's somewhere close to 20% in Sydney, maybe a bit less in Melbourne, 10 or 12, depending what numbers you look at. And you can't sustain that sort of growth. Like, I think Tim Lawless at CoreLogic the other day suggested, we could be back at the peak median price of around June 17 by May this year. I'm hoping there's enough of a slowdown that is pushed back to September quarter or maybe even December quarter. So it's at least 3 or 6 months later than he's suggesting, because affordability will become a significant issue, because this is all being driven now by very low interest rates, improved credit availability, and but people's incomes aren't growing at a significant rate.
But people like you and me often rely on history, but we also, as economists, know that sometimes history doesn't help us because structural changes happen. And the biggest structural change that I can see in the housing industry is these low interest rates. And they could be low for a long period of time, where you and I were used to, okay, there's your interest rates, you get some growth, they start sneaking up, and then it comes off the boil. But this is a long time, and on most forecasts,
you can't see significant rate rises until the economy is running at 3 or 3.5%, maybe in minimum 2 to 3 years. So, look, obviously another 0.25% rate decline yesterday on Tuesday. So look, maybe because we're coming off a lower base, maybe there's a return to more normal interest rates sooner. But certainly, if you started to say, look, people will be affected, certainly if rates went up 1 percentage point to 1.5, that would be substantial, because if someone's only paying 3 to 3.5% and rates go up by percentage points, that's a huge
on a big
increase.
borrowing. Yeah.
That's a huge increase in mortgage repayments. And so I think, people have to, work on the basis that, and you'd hope the banks are doing that effectively you're assuming that rates could go back to something in the 5s at some point, 3 to 5 years out.
Yeah.
And on that basis, okay, if you've got that built into your numbers, well, great. But if people are all out there battling for properties and there's been a shortage of supply, which there has, but of course at any point in time in a market like Sydney, you could argue that 50% of the market should be always taken up with people who are buying and selling in the same market as owner-occupiers, basically. The variables are largely the first home buyer numbers and also then the investors. Now, clearly the investor, there was a period there where investors were counting for nearly 50% of demand, which was ridiculous. I think there's been a reduction in home ownership, so maybe that figure should be closer to 35%, not 25 to 35. 25 to 30. These are interesting times.
So, Rob, it seems to me that when we do eventually get some normal growth in the Australian economy and interest rates start to rise, I guess with wages, it suggests to me that there will be eventually a pretty serious recession. Like the recession that followed the 17 or 18% interest rates that you and I actually lived through.
1990, 91.
That's right. So it's like there's going to be a very long party, but eventually there'll have to be a serious recession somewhere along the line.
Yeah, you'd sort of think, we're sort of heading towards 30 years, and while the likelihood of it in the next 2 or 3 years, barring, out of the coronavirus, basically having a much more significant effect rather than being a 3-month event or something. If it's not from that, then something else will come and it'll be all self-inflicted, that we will get back to some period of higher inflation. When you've studied your economics and worked in your early career through the 70s and 80s, you sort of always have, I always thought post-GFC that there'd be inflationary pressures develop because of the money out there, and not just the Australian economy, but the world. And to a degree, we keep living off that. And it's, I must admit, there's sort of some irony out there at times in terms of the way we look at things. We're sort of worried about income growth not being enough, and people people not spending and being cautious. But then, on the other hand, we sort of decry the massive level of debt that we have, the consumer debt. And you sort of think, well, the only way that can be rectified is by people being cautious and not spending enough. And that's basically what's happening. They're paying off mortgages and,
those repayments, the buffer is the biggest it's ever been, isn't it?
So basically, that means that for anyone who's had a mortgage, for 5 years, they're in a pretty good position. The people who would be in a bit of trouble with the downturn certainly would have been those who bought in the 12 months before the peak, so 3 years ago. They will have found it tough, and obviously they'll be very happy there's been a rebound in price if they did have to sell. But unemployment's not bad, so unless we get a more severe impact from this weakening in China and other flow-on effects from the coronavirus, then I think we'll be okay. But look, the reality is, we as a company, Oxford Economics, with what's coming out from overseas, are becoming more pessimistic by the day in terms of the worldwide economic impact.
Don't say that, Rob. It's the influence of those Englishmen in your organisation. We Aussies are always positive. Now, one area you guys do look at is construction, and construction is going to be very important for growth. And then my argument is, I hate these interest rates being so low, and I hate the fact we're getting all these house prices. But if the Australian economy can grow, at least offset some of the excesses.
Yep.
Is construction turning around? Because it went into a bit of a hole.
Yeah. Look, building approvals came out yesterday, so the dwelling numbers probably, they weren't flash, but that was after probably a November and December number where apartments, firstly in New South Wales and then Victoria, were way higher than we expected. I don't know what drove that in terms of, it looks like a one-off factor in the case of New South Wales because the December and January figures have softened.
Yeah.
But look, probably in seasonally adjusted terms, you'd be certainly getting growth in the June quarter. In terms of dwelling commencements, I suspect September quarter, without a doubt, you'll see modest growth on a year prior. So construction, building companies, building materials people, during the September, depending on where you are in the cycle in providing product or whatever into that sector, they'll start to see some improvement. More in detached housing than apartments, so we think this will be a more owner-occupied driven detached housing upturn, and that the next cycle will actually take detached housing to well above what we were building 2 years ago. But apartments, high-rise apartments, will be probably still significantly short. Probably the big question mark will be, what time do investors really return to the market in terms of buying off the plan? We think that's probably still 12 months or so away.
Yeah.
All the concern about building quality has to continue to lead to caution.
Yeah.
And but on the other hand, people will be looking there and thinking, if prices were to keep going up 8 or 10%, forget the 20%, maybe I could get a bit of that. And at such low interest rates, this is a pretty good time. My personal view is I'd like to see continued more first home buyers in the market and less investors.
Yeah.
And I think what we're seeing in terms of, again, the core logic data suggests that the lower quartile price movements are more in the region of about 6% on a year ago, not 12% at the upper quartile. So that would indicate that people buying in those middle to outer suburbs of Sydney in the lower quartile price range are only probably at least are being sensible and are not fighting over properties and forcing prices up at a ridiculous rate. Because if the overall median in Sydney got back to only 5 or 6%, I'd be quite happy. And if that happened seriously in the next 3 to 6 months, I think our forecast for next financial year is about 4.5. But it'll be a lot more than that in the calendar of the year because it'll be, we could be up 6% or more in the first half of the year.
All right, I didn't think I'd ask this question, but only because you are no longer a wet behind the ears operator in this industry. If you had the power to change negative gearing as it currently exists, A, would you do it? But B, if you had an alternative magic wand where you could increase the supply of properties by maybe stopping the government negatives on people actually building, developers building properties, which one would you go for? Or would you do both?
Look, I think you probably have to do both. I think continued allowance of negative gearing is a right policy. However, I at times think it could be helpful if there was some limit placed on that. So the limit could be in terms of number of properties or a dollar value that you're allowed to deduct.
Yeah.
Obviously, the value of negative gearing in the current climate with such low interest rates is actually probably lost compared to what we saw in past times. So I think there could be some advantage in putting some limits upon it, but continuing to allow it. Without a doubt, I mean, you've only got to look at the US market, which obviously the US is made up of a lot more cities of sort of 250,000 to 2 million people. The place is spread. Obviously, suburban development's a dominant thing in many cities of sort of modest size, cities that are obviously a lot smaller than Sydney, Melbourne or Brisbane. But they look at median house prices of 300,000.
Yeah.
And this is there's just a fundamental difference between the two markets. For whatever reason, as Australians, as I've sort of explained to a few people, we're quite prepared to spend more money of our income on mortgages and on housing. In the US, they spend way more money on health and defence. I mean, if you look at any stats, the percentage going into those two items is way, way, way above what we do. But it's counterbalanced by the fact that we spend money on housing at a high rate. Is it sustainable in the long term? Probably not. But certainly it's all about increasing supply. I mean, I've been called in and talked to politicians and other people over the last 30 years. Bob Hawke had a housing summit back in about 1989. The bottom line is you've got to improve the supply situation.
Yeah.
But even a market like Melbourne that's had the best supply situation, they've had all that relatively cheap land in Docklands for apartment construction. They've had readily available land out in the suburbs with less restrictions.
A place like Mount Atkinson's a new project area, 6,000 homes are coming into it. Yeah.
So they've had that, but despite that, probably the last 12 months of the boom, they had 30% increases or more in land prices. So, there comes a time where demand pressures, and look, Victoria, Melbourne's had phenomenal growth in population, way above Sydney in the last 10, 15 years, and particularly the last 5 or 7 years. But even when you get more supply, we still see substantial growth. But look at the movement in the last cycle. Sydney median house prices are up about 85%, and probably Melbourne was in the low 70s. Now, there was 10% of, and to a degree that probably explains how much Sydney went over the top, particularly in the last year of the cycle. They went over the top, it was ridiculous, and that's why it needed to have more substantial correction.
Yeah, but look, my last question to you is this, and I've had this number in my head and I've written stories about it, it might have been relevant to a particular state, but I remember writing that about 30% of the developer's costs in building a home and land package are government charges. Is that, if it's right, and shouldn't we be asking government to stop milking the whole system so properties become cheaper?
Yeah. Look, I've argued for a long time that our generation basically had so many costs associated with development paid for by the council or by state government, rather than having development levies that effectively are trying to get contribution from the developers, which is what's operated more over the last 20 years. And those levies at times are ridiculously high. If you want to actually, there's no point politicians sort of sitting there and crying poor about how tough it is and something has to be done about affordability. If, as you say, and I think you're right, the numbers are around that 30% mark, you've got such high government-related charges, whether it be local government or state government, impacting upon the cost of land. And it's all about land, it's not the actual... we actually build dwellings at a fairly efficient rate in Australia. The costs over time, rise pretty much with inflation, and that's it's in line with what you'd expect for building materials costs or labour costs. It's all back to land, and at the end of the day, Sydney particularly is constrained by where it can build, and we continue to open up areas to the the west, northwest, and southwest, and that's all good and fine, but unless we build a fast train and we suddenly open up between down to Mittagong and Goulburn and those places, they'd be the areas that would have to be developed if you want to move beyond the sort of 60k radius. And look, there's still a fair bit of land in the southwest, but some point 20 years, 30 years from now, there will be limits upon that. And the thing is, Sydney people more than Melbourne people want to live closer to the city. Now that's actually being met by high density, and the younger people seem to be happy with that. The older people are less happy about that and less accepting of that, but that's a choice people make, and if that's what they want, then that's what we should be able to make sure we provide that. But of course those increased densities then have some issues with regard to traffic and a whole range of other things. I suppose there are some good signs there actually in the fact that there is a rapid increase in the use of trains, public transport generally, and so that's probably a positive that the next generation coming through probably won't be using roads as frequently to get to work as our generation, and I think over time that's a positive for positive for society basically in terms of things, costs. But if you want a house and you want to live within 20 or 30 kilometres of Sydney,
You're going to pay.
you're going to pay.
Rob Miller, thanks for joining us.
Great, thanks.
That's Rob Miller from BIS, Oxford Economics.